Well, and it's not even the mainstream talking about it yet. These are the top analysts at commercial banks who are not speaking to the public. They're speaking to their institutional clients first. Again, the big money. So the big money, the central banks and the commercial banks, well, they've already got their seat at the party. Now they're saying to their big money who they want to take with them on the ride, reallocate. But the people down here, they don't hear any of that yet. When they're told to reallocate, you might want to start to think about what happens next, because the big money will have been in position long ago. And that's when all the profits are made. And, again, we don't buy this stuff to get wealthy. We buy it because it is wealth. And the biggest money in the world is signaling that right here in front of us.
In every monetary system in the past, there comes a moment when the illusion finally breaks. When paper promises, no matter how sophisticated or digitally dressed, are weighed against something real and found wanting. That moment, as Andy Schectman warns, may already be here. Despite record short pressure on SLV and GLD, gold and silver are refusing to yield. If gold and silver are holding this strong under record short pressure, Schectman cautions, what happens when that pressure fails? And I think it is failing. It's a statement delivered not with excitement, but with inevitability. The truth beneath the market euphoria is simple. The world is revaluing money itself. Schectman points to a flood of institutional conversions, from Morgan Stanley's new 60-20-20 allocation model to Bank of America's 25-25-25 portfolio, all breaking from the old 60-40 orthodoxy. What was once the backbone of Western wealth management has fractured, replaced by a quiet migration into gold. This isn't speculation, it's preparation. The smart money is positioning for a world where debt-backed currency no longer guarantees value, only the illusion of it. And while the analysts speak in percentages, central banks speak with actions. They've accumulated more physical gold in the last 5 years than in the previous 60 combined. The East, China, Russia, and the BRICS bloc is building a new vaulting infrastructure, connecting Shanghai, Dubai, Singapore, and St. Petersburg. These will all be connected, Schectman notes, and tied to this gold vaulting system where nations' gold is held in their own countries. The symbolism is unmistakable. Sovereignty secured by metal, not by promise. Meanwhile, Western stability is being engineered through financial sleight of hand. Tether's new USA stablecoin, Schectman reveals, will be backed entirely by U.S. treasuries, a clever mechanism to create synthetic demand for an asset that no longer has organic demand. Yet even Tether, the issuer of digital dollars, is using its profits to buy physical gold. The irony is almost poetic. Those creating digital money are converting their gains back into tangible metal. Schectman's warning is subtle but profound. Watch what they do, not what they say. While public investors chase yield in Treasury ETFs, the architects of the system are quietly buying ounces, $8.7 billion worth of gold, held in Swiss vaults. While headlines praise the resilience of the dollar, the insiders prepare for its reckoning. It's not about gold, he says. It's about loss of purchasing power in all of these currencies, and all of these currencies are now basket cases. Silver, often the forgotten metal, is emerging as the canary in the monetary mine. Silver futures have soared past $50, defying the weight of short positions that once suppressed them. Nearly 11,000 tons of silver, about 60% of global mine supply, have flowed into the U.S. this year. The movement signals not speculation, but recognition. The market knows, the price may not yet reflect it, but the fundamentals do. What happens when the suppression fails, when the tide of shorts finally breaks against physical demand? Schectman doesn't hesitate, a revaluation. Now we'll show you more clips of the latest interview, but first smash the subscribe button and turn on notifications so you do not miss out on our daily recaps.
And I just think that people in this country have yet to recognize that gold is rising, and rising against all of the G7 currencies. But it's not about gold. It's about loss of purchasing power in all of these currencies. And all of these currencies are now basket cases. So yeah, I think that, wait until China really starts to turn up the heat and starts to dump treasuries at a faster clip. I think maybe that's why we're seeing all the gold come back and the talk of tying gold to a new monetary system, because in my mind, as much trouble as China is having, their yuan gets saved by gold, and the dollar without gold to back it, it goes down. And maybe that's why we're seeing all of this gold come back, to have it tied to a new system. I'm not really sure, but when we see China building vaults all throughout the global south, starting with Hong Kong and then Saudi Arabia. You'll have the vaults in St. Petersburg, of course in Shanghai, in Singapore, Dubai. These will all be connected and tied to this gold vaulting system, where nations' golds are held in vaults in their own countries. And I think that'll be ultimately trusted much more than what we see in New York and in London. Jeffrey Gundlach, he is they call him, that just came to me, call him the bond king. And he is saying that that it's time to move away from traditional 60-40 split. This is a guy who in essence, it's like the casino betting against their own game, speaking out against their own game. He's saying that you'll see gold at 4,000 by year end. And he talks about that your savings account is bleeding out, at least at 4% per year, but actually it's probably a lot more than that. They talk about a money supply that has increased by as much as 7% per year. You see M2 again racing higher right now. So as we see money creation running at such a level, your $10,000 right now after an 11% drop is worth $8,900. And so if you're buying treasury bonds paying 4%, that's $400 a year on your $10,000. The IRS is going to take $100 of that right off the top of your $400 profit. But when you look at the debasement of the currency, you're negative between taxes, where if you're buying bonds and it's like the government is taxing you for lending them money, which is really stupid. But between the monetary dilution of money supply growing at between 7 and 10% annually, the dollar down 11% now, the taxes on top of all of this, it's a losing game. It's no wonder that they don't say this. So, your $10,000 just lost $700 or $800 or $900 in real purchasing power, if not a lot more, actually more like $1,200 or $1,300 in less than a year. And that's the kind of thing that I think is really, this is what owning precious metals is all about. You would think by now people would wake up to this, especially since gold prices are up 43% this year to date. This is putting them on track for the best annual performance in 46 years. You would think that people would start to wake up to this. Unfortunately, they're always late to the party, i.e. the little man rule. It's the big money who is there right now, and it's the big money that is moving in this direction. I want to talk a little bit about, I try and touch upon the BRICS a little bit each time. Sometimes it's hard because sometimes the information's hard to find, or it just isn't really earth-shattering. This is one of these deals that really isn't earth-shattering, but I think people should pay attention to what they're doing. So, I think that the U.S. is foolish in the way that they have stood up against the BRICS countries with tariffs. And soybeans, China used to be the biggest purchaser of soybeans from U.S. farmers. And you look at the Chinese import numbers for soybeans in August, they were at historically high levels, like the most ever. But the majority of these purchases are now coming from Brazil and other South American growers. And over 12 million tons of soybeans came into China in August. It's the second highest monthly total ever. And almost all of it, 11 million tons or more, about 85 to 90% of all of the soybeans came from Brazil. And now China has logged 4 consecutive months of record soybean imports. And this is, again, I think it's because of supply uncertainty with the United States, because of the trade war. Okay, well, so what, people would say. Well, this is, to me, a very big so what, not only for the American farmer, but also for the American government. Most of these global soybean trades were invoiced in U.S. dollars. And now they're not. And so payments would have to clear through U.S. dollars through the international intermediary banks via the New York clearinghouses. This gave the dollar its dominance. This is what I've been talking about, in our conversation today with Rick and Alistair earlier, talking about chipping away at dollar dominance through settling trade, whether it be the BRICS settling trade on government-to-government level like this, which I'm going to touch on in 1 second, or the BRICS Pay Network, which will allow business-to-business, retail, business to the retail market also to transact outside the dollar. Every one of these transactions is like an axe against like one of the giant redwood trees. Or the Shawshank Redemption, where Andy Dufresne used a little spoon or whatever to chip away at the wall over time, chipping away at this new system, which isn't using dollars to settling over whether it be BRICS Pay Network, whether it be over the BRICS Bridge Network, or they have something called a direct yuan clearing arrangement that they made in Brazil. Chinese did, and it allows the exporters, including the big soybean exporters, to invoice China directly in renminbi across the renminbi cross-border payment system, which settles in 7 seconds outside of SWIFT. And so this cuts out the U.S. dollar out of the loop completely. So the Chinese importers pay in yuan, and the Brazilian sellers can either hold the yuan or convert them into gold or real if they want. But converting them into gold, and soon in all of these countries, whether it be the BRICS countries or the Belt Road, they'll have Shanghai vaults where metal is stored in all of these jurisdictions, all these multi-jurisdictions. And so you have the system that is being built little by little to cut out the dollar completely, not only in settlement, but also in reserve status. Instead of putting excess into treasuries, they will simply put them into gold, because gold is backing this whole system. These are the things that a lot of the people who do not talk about, who push back against the BRICS and say that they are not as legitimate as perhaps we would think they are. And to me, that is a very silly mistake to make.
The illusion of fiat stability, of endless debt masked as wealth, is dissolving. The so-called safe assets of the last generation are bleeding in real terms. Your savings account, Schectman reminds us, is bleeding out at least 4% per year, but actually a lot more. The money supply is rising by 7 to 10% annually, while the purchasing power of the dollar has fallen 22% since 2020. This is not volatility. It is monetary decay, slow, deliberate, and irreversible. As Schectman frames it, we don't buy this stuff to get wealthy. We buy it because it is wealth. Gold and silver are not investments. They are escape hatches from financial delusion, the foundation of a post-fiat reset. Every empire's currency ends the same way, in debasement, denial, and finally, in rediscovery of real value. Today, the world stands on the threshold of that rediscovery. The paper illusions are burning away. The foundation of real money, the elemental, incorruptible truth of gold and silver, is rising once again. And when the pressure finally breaks, as it always does, those holding metal won't be watching the collapse, they'll be insulated from it. Let's get back to the interview.
We've talked a lot about silver and how the open interest in silver had declined from 184,000 contracts in June to 154,000 in September. This means that there was covering in contracts. That means that the open interest was declining. Yet the price continued to rise above $40 in the face of a declining open interest. Declining open interest, meaning less people involved or speculating, and rising price, in theory, only happens in a bear squeeze, where the shorts are covering because they're afraid. And now I would argue it's rising because the long speculators realize that metals are in a bull market. And you got to wonder what the shorts are thinking right now as it continues to move higher. But you see all of the silver coming in, almost 11,000 tons of silver have come in this year. About 60% of global mine supply for 9 months have come into the United States. And so basically what you're seeing is, I think, a reawakening again of what silver has to offer. Now, if being on the short side of this has to be terrifying, as we're seeing now massive investment interest in there, maybe this is why we're seeing such a huge short position in SLV. They're running out of ways to hold the price down. And in the face of rising short positions, silver and gold are still doing well. Of course, they're doing it in SLV and GLD, a little bit more opaque, instead of putting it right on the COMEX. But even still, you're beginning to see big money start to challenge the suppression of gold and silver. And I don't know, I think that it's not just gold and silver, it's platinum, which is up almost 65% this year. And so, yeah, you're seeing, again, what's China doing with platinum? They're importing platinum at a run rate of 58% of global mine supply. Again, it's not just gold and silver, it's everything. Precious metals, base metals, commodities like soybeans. They're doing everything they can, and they're paying for it and doing it in ways that are pushing back against the dollar. But to my point about the short positions, the short position in SLV exploded 67% higher, and gold almost 70% higher. This is aimed at keeping metals down. Now, normally such a barrage of these shorts would crush the price. It's textbook suppression. Flood the market with borrowed shares, push the chart flat, kill the momentum, kill the rising price. But the effort, this enormous effort to hold it down, is pale in comparison to the demand, which is even stronger. And I think that's very, very scary to these shorts. If gold and silver are holding this strong under record short pressure on SLV and GLD, what happens when that pressure fails? And I think it is failing right now. So yeah, I would expect to see much higher prices in gold and silver moving forward. I really do. And I don't know, I think it's just the beginning, Donegan.
What do you think of today's episode? Do you agree with Andy Schectman that LBMA silver drains signal supply shortages and monetary control is destroying American freedom? Is the Genius Act just central bank digital currency by another name? Will silver shortages trigger the crack-up boom Andy warns about? Post in the comment section down below your honest opinion. Share this video with someone who values monetary freedom. Thanks for watching.